Is trading the stock market just gambling with extra steps? A lot of people believe that. And honestly, for most untrained beginners it kind of is. Not because the market itself is rigged, but because they skip the one thing that separates a trader from a gambler: a plan. Over the next 10 minutes, we are going to build that plan from the ground up. Welcome to Equity Market Trading. I am your trading educator for this course, and together, we trade the NSE and the BSE, the two exchanges that define the Indian stock market. This channel exists for one reason: to take what usually takes years of expensive mistakes to learn and hand it to you clearly and directly. By the end of this episode, you will understand the real difference between investing and trading. You will understand why a company chooses to go public in the first place. And you will understand the 4 beginner myths that quietly and consistently destroy new traders' accounts. This is episode 1 of our beginner series. Let us begin from zero. This is episode 1 of a 13-part course. Across this series, we move step by step, from knowing absolutely nothing about the stock market to reading a candlestick chart with confidence, from guessing to managing risk like a professional, and finally, to placing your first real trade, backed by an actual written plan, rather than a hunch. Let us start with the fundamental question. What is a stock market? A stock market is an organized, regulated marketplace. Here, shares of publicly listed companies are bought and sold every single trading day. In India, 2 exchanges matter above all others. The NSE, the National Stock Exchange, established in 1992 and today India's largest exchange by trading volume, and the BSE, the Bombay Stock Exchange, founded in 1875 and in fact the oldest stock exchange in the whole of Asia. Now here is the part most beginners misunderstand. When you buy 1 share of a company, you are not simply buying a flickering number on a screen. You are buying the small legal fraction of a real business. Its profits, its growth, and yes, its risk become partly yours. Why would a private company choose to list itself publicly, opening its ownership to complete strangers? 3 reasons stand above the rest. First, to raise capital for expansion without taking on expensive debt. Second, to give its earliest investors and founders a genuine path to exit their position and realize their gains. And third, to build public visibility and the credibility that comes with regulatory scrutiny. The listed company is by definition the more transparent company. Now, why do people like you and me choose to invest or to trade in the first place? For some, it is wealth built patiently over 10, 20, even 30 years. That is investing. For others, it is income captured from short-term price movement within days or weeks. That is trading. And there is a third reason, one that beginners consistently underestimate: protection from inflation. Cash sitting idle in a savings account quietly loses real value every single year, while equities have historically outpaced inflation over any sufficiently long period. Here is, without question, the single most important distinction in this entire episode. Investing looks years, even decades, ahead. It is built on the fundamentals of a business, its earnings, its management, its competitive position. Trading looks days, or at most, a few weeks ahead. It is built on price action, market timing, and disciplined risk control. Confusing the two is precisely where most beginners lose money. They enter a trade planning to exit within days. The price falls, and suddenly, without any new analysis, they declare themselves a long-term investor. That is not strategy. That is denial, wearing a costume. Let me make this concrete with 2 real approaches. Ramesh invests 5 lakh rupees into a diversified basket of mutual funds. His plan, decided in advance, is to hold for 15 years toward retirement. Priya, on the other hand, buys shares of a bank stock on a Monday morning, expecting a 3 to 5% move by Friday, based on a clear chart pattern, with a strict stop loss already placed. Both approaches are completely valid. But notice they demand entirely different skills, entirely different temperaments, and entirely different systems of risk control. Neither is superior. They simply are not the same game. So let us return to our opening question. Is trading gambling? Trading is not gambling when it is built on a defined statistical edge, a written plan, disciplined position sizing, and real risk control applied every single time without exception. It becomes gambling the very moment you trade on a tip, on emotion, or on the fear of missing out. The market does not know or care which one you are doing, but your account balance, over time, absolutely will show the difference. Let us clear away 4 dangerous myths right now before they cost you real capital. Myth number 1. You need a large amount of money to start. This is false. A disciplined beginner can start with just a few thousand rupees and build proper habits before scaling up. Myth number 2. Trading guarantees fast wealth. This is false. The honest data shows most untrained beginners lose money in their very first year. Myth number 3. Technical analysis reliably predicts the future. This is false. At its very best, it estimates probability. It never offers certainty. And myth number 4. More trades always mean more profit. This is false. Overtrading driven by boredom or impatience is one of the fastest, most reliable ways to destroy trading capital. Before you place a single trade, ask yourself 3 questions every single time. What is my entry point and why exactly this price? What is my stop loss, the exact point at which I admit I was wrong and exit? And what is my position size, calculated for my risk tolerance, not from how much cash happens to be sitting in my account? If you can't answer all 3 questions clearly before you enter, you are not trading. You are guessing with money attached. Write these 3 answers down every time before you click buy. This single habit, more than any indicator or any strategy, is what separates consistent traders from everyone else. Let us bring this together. A stock market allows you to own a genuine fraction of a real, operating company. Investing targets long-term wealth built on fundamentals. Trading targets short-term price movement built on discipline and timing. And above everything else, a written plan paired with real risk control is precisely what separates a professional trader from a gambler. In our next episode, we decode the language of this market together. SEBI, the NSE, the BSE, the IPO process, the Demat account. Every term explained clearly with no jargon left unexplained. Until then, trade with discipline, protect your capital first, and I will see you in episode 2.